So in the previous lesson, we have seen the option chain for the call options as well as the put options of Tata Motors. But on the screen of the trading platform, it appeared little confusing because of several unwanted information and data available there. So what I have done is, I have taken the extract of all relevant information and tried to put them on a single screen for the ease of explanation as well as for the ease of understanding. Alright, so what you see here on the screen is basically the option chain of Tata Motors for the July 21 series. When we saw on the trading platform, the option chains were available for the month of June, July as well as August 21. But I have not selected the June series because the June series is expiring in a couple of days. Therefore, for a holistic picture, I have selected the July series. Alright. Today is 16th June and this option chain is expiring on 29th July 2021. So the number of days to expire from today are 43 days. Alright. And the underlying asset is Tata Motors. The spot price or the market price of the underlying asset, that is the share of Tata Motors, as on the time when I have taken the screenshots, was 337.4, whether rupees or dollars or reals, that is immaterial. And the lot size is 2850. Alright. And what you see here in the table, in the center column is the strike price, the various strike prices starting from 310 to 370. So these are the strike prices which are available for trade for the month of or for the series of July 21. On the left of the strike price, what you see is the premium payable for the call options. Alright, so these are the call premium. And on the right side of the strike price, what you see is the premium payable for the put options. Okay, and certain columns you see blank. So these blank columns are those where the trade is not taking place at the moment. All right, so those columns have been left, or those the cells have been left blank. Don't worry about that. Now we know that when the spot price and the strike price are the same or almost the same, that option is called as at the money option in both the cases, for call options as well as the put options. All right, so these two prices, what you see, the strike price 335 and 340, they are the closest to the spot price, that is 337, or rather I would say the spot price is exactly in the middle of these two. So there is no single ATM. Both these strike prices, we can consider them as at the money. Got the point? Both for call option as well as for the put option, ideally there should be one strike price which can be called as at the money. But here the tick for the strike price is in 5 rupees or $5, whatever it is, like 10, 15, 20, 25. And the spot price happens to be exactly in the middle of 335 and 340. So therefore, both of these 335 and 340, I am considering them to be at the money. All right. And then we also know that when the spot price, this is the spot price, when the spot price is more than the strike price, it is more than all these strike prices. In such case, the call options are called as in the money call options. So all these call options, these three call options which are available for the July series, are considered or called as in the money call options. And we also know that when the spot price is higher than the strike price, then the put options are called as out of the money put options. So on one hand, these call options are in the money and these put options are out of the money. Similarly, we know that when the strike price is more than the spot price, this is the spot price 337 and these are the strike prices 345 to 370. So when the strike price is more than the spot price, those call options are called as out of the money call options, and the put options are called as in the money put options. All right. When the spot price is less than the strike price, then these put options are called as in the money put options. So exactly the mirror image what you see. All right. Now please note that as the strike price is increasing from 310 to 370, as the strike price or the deal price is increasing, we find that the call premiums are reducing and the put premiums are increasing. Why so? If you just recollect the previous lessons, then you will find answer for that. You see, the call options are the choice of buying. All right. So when you want to buy something at a price which is lesser than the market price, all right, all these prices are lesser than the market price, so you have to pay a higher premium. And similarly, the put option is the choice of selling. So when you want to sell something at a price which is lesser than the market price, then obviously the premium will be less. All right. And similarly here, when you want to buy something at a price higher than the market price or the current price, then obviously your premium will keep on reducing. And if you want to sell something at a price higher than the market price, then the premium will keep on increasing. So I am not, trying to explain to you any formulas or equations which are normally done for teaching options, because I know that formulas and equations will not be remembered and memorizing such formulas are of no use. So I am trying to explain to you in simple terms which you will remember. All right. Now, having seen this, the first question which will come to your mind or which you should ask me is that what does the premium depend on? These are the premiums for the call options and for the put options. What does the premium depend on? And my answer would be that the premium depends on several things, which we shall be discussing subsequently. But the two most important things on which the premium depend are the time value and the intrinsic value. The time value of the option and the intrinsic value of the option. Now, what is this time value and what is the intrinsic value of the option? We shall see in the next lesson. All right.